what is owning a home when you don't actually own much equity in that? It's renting a home. When you buy the home, maybe make a few payments, and then as soon as the value of that home increases, you do a cash out refinance, that continues to be renting.
Yes.
This podcast contains the arguably witty banter of two friends, Skippy and Doogles, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Skippy and Doogles are back. No Deckers this week. You sad about the no Deckers?
Deckers is happening this week. I'm wearing Uggs right now. What are you talking about?
We can't see it, but he's wearing
My
Uggs.
feet are so cozy up inside the sheep. You don't even know.
Skippy has built himself just a giant Ugg boot, and he's sitting inside of it right now.
Yeah, my family might not go out with me this weekend, but I'm having fun. It's all good on my end.
Oh, that's absolutely fantastic. As always, skippydoogles@gmail.com. Hit us up with that listener mail. And we got the Instagrams, the Twitters. Go follow us. Skippy Doogles is our handle on everything. And skippydoogles.supercast.com, which we don't talk about as often. That's where you can get a premium subscription. Go check out our offerings. Let's hop into it. We got 3 topics for y'all today. We're going to start off with talking about people in America that is house rich and cash poor. Give you some stats on that. And I'm going to start off with an Instagram reel for you to listen to. Then we're going to jump into the latest Howard Marks memo. This came out about a month ago, but we've been decking it out, so haven't had time to talk about it. It's called The Calculus of Value. And I'm going to wrap it up with Kawhi Leonard and his latest shenanigans. Alleged shenanigans?
Aspiration. Uncle Dennis. It's so great. For those who don't get the joke, the last 2 weeks was a deep dive on the 50-year history of Deckers Outdoor Corporation, which owns Teva, Hoka, UGG, among others. That's a really fun episode that we got great feedback on if you're interested in a company history thing. But today is back to the normal banter.
Back to the norm. Do go listen to those, though. They're fun. They're different than what we normally do, but they're fun and informative. Go listen to those. Okay. House rich, cash poor. First, listen to this. I want to get your view on this right here.
Rich live better than the poor and middle class, not because they have more money, but because throughout their entire life, their most valuable asset was never their primary residence. This is why 66% of people own their own home, but only 1% are rich. You can see here, for most people, their primary residence makes up at least 50% of all their assets. That literally does not happen at any time in a wealthy person's life. Here's Warren Buffett to explain.
When is the best time to buy a house, and how much down payment you should be putting down?
Well, Charlie's going to give you an answer to that in a second. I'll just relate one story, which was when I got married. We did have about $10,000 starting off, and I told Susie, I said, "Now you know, there's 2 choices. It's up to you. We can either buy a house, which will use up all my capital, and clean me out, and it'll be like a carpenter who's had his tools taken away from him, or you can let me work on this, and someday, who knows, maybe I'll even buy a little bit larger house than would otherwise be the case." So she was very understanding on that point, and we waited. I decided to buy a house when the down payment was about 10% or so of my net worth, because I really felt I wanted to use the capital for other purposes.
For the rich, most of their assets at all points of their life are in investments in business, public or private. Their primary residence never goes above 25% of their wealth. Most of the time, it's below 10. The rich do not buy a giant home and try and grind their wealth up. That is literally too hard. That is something the poor and middle class do. They put most of their wealth, in this case, the bottom 80%, put over 60% of their wealth in a primary residence, and then wonder why they can't get rich. It's because the anchor is too heavy. Never forget, a home is not an investment. Quote, don't buy a home as an investment. It's literally just roof over your head. It is shelter. We live in a home, but we live off our investments. You will never become wealthy from owning a primary residence. A middle-class home yesterday is still a middle-class home today and will be a middle-class home in the future.
What do you think?
I swear I'll get back to it, but I can't get over Buffett pretending he only had 10K at that time. And also the flashback of like the story with his 1-year-old daughter, and he's waking up on Saturday at 4 a.m. to take the train to some manufacturing facility in New Jersey where the CEO effectively gives him an insider tip that some acquisition is happening so he can like Buffett pretending to be poor is the most hilarious thing ever. When he had like 11 grand as a 10-year-old, and he bought a farm at 14, but
there's many things there. First of all, when he says my wife, I go, oh, which one?
Stop it. Going to get us in trouble. I mean, generally pretty decent advice. I think that borders along people trying to live off their life off a spreadsheet when your life is not a spreadsheet, and it's easy to say.
Yep.
But 100%, you want to buy assets that appreciate, and you want to send as much money to that as possible. Your primary residence sometimes can be an investment, but for 99% of people should be thought of as the place you live and not an investment. And so if your goal in life is to grow your wealth, the easiest way to do that is through business ownership, bar none.
Yep.
And you want as much money as possible to go into buying businesses or parts of businesses. It's pretty simple stuff.
But that's not the prevailing wisdom that's shared from the generations henceforth. That's why I think that it might be when you look at the numbers, I do think, as you stated, it's pretty simple stuff. But I don't think that that's what's been taught. I don't think that that's the part of the American dream, I believe, as it's been told. I'm not saying this is the actual American dream, but part of it has just been pinned to homeownership.
Elaborate on that, because I don't know that I feel the same. Yes, there's the American dream. So I think of the American dream as something that's different than the path to get wealthy, if that's your goal. So the American dream can be the 2.3 kids, the dog, the home, whatever else.
Yep.
No one says that the American dream that you're going to be worth 5 million or 10 million or 50 million bucks. Yeah. What this perspective, that realist perspective, is like, if you actually want to be wealthy and a person that can ultimately live off your investments, you have to take a different path. But I don't know that directly overlaps with the American dream.
Here's where I think it does, because I agree with what you just stated. However, when I read or hear people talking about how either the American dream is dead, or I can jump off the American dream because I don't want to pin it to something that could mean many things to many people. But when they talk about not being able to succeed, whether that's getting incredibly wealthy or not, a lot of what ends up coming up is, I can't even buy a house. And it's like, okay, well then don't. But buying a house shouldn't be viewed as something that has to be a milestone on your path to personal success, however you define that. And it seems like that is. There's so much complaining about not being able to buy a house.
No, I had a family member come to me, and they're thinking about buying a house. Luckily, they're moving to a place where it's kind of affordable. More affordable than your average spot in America. But we just went back and forth. I just sent all the graphs that say, look, it makes more sense to rent right now than it does to buy. And you're along for the ride. You don't control that.
Yep.
But it may be the worst time to buy a house in the history of the country, like depending on what market you're in. And there's been the reverse of that in the past. There's been times where it is the best time to buy a home in the history of the country within the past 30 years, probably, with a combination of interest rates and home prices. But I think you play the hand you're dealt that way.
One thing, and then I'll hop into some of the stats of part of the meat of what I also want to talk about, is when I bought, and people, if you want to relive this, you can go back to like episode 4 or something of this podcast, and this is happening. When I was looking with my family to purchase a home, I was sitting in this place where I was like, why in the heck would I buy a house when I could do so much else with this capital?
Yeah.
This is not a good investment. And you, Skippy, you said, okay, it doesn't have to be an investment. It's shelter. And think about this as, if you look at some version of this statement, if you look at your family needs shelter, you can look at the difference between rent prices and home prices, look at the location of where you want your family to live. It's maybe not a financial investment, but an investment in family. That got me mentally to a better place. And today, my wife and I were talking about this recently. Today, if we had, instead of purchasing this home, if we had instead just kept our assets where they normally would be, our net worth would be something like 50 or 60% higher than it is today. But our family unit is stronger because of where we chose to live, the neighborhood that we're in, the friends that my son has, etc. So there's other ways to look at it, and I'm thankful for you for helping me. It would have happened anyway because my wife wanted to do it, but I'm thankful for you to getting me to a healthy mental place. Okay.
I mean, I'd argue that the investment returns on paper in terms of cold dollars are less, but holistically they're actually more.
Yeah, that's right.
That you're better off.
Yeah. Here's some stats. So ICE, not that one, people, calm down, not that one. The Intercontinental Exchange does this mortgage monitor. And so they're looking at different mortgage rates, what people are doing with their mortgages, mortgage originations, et cetera, et cetera. Here's something that came out for Q2 of 2025. Cash out refinances. So that is when someone refinances their home. They go and take a new mortgage out on their home, get whatever the prevailing mortgage rate is at that time, and take out money. That's a cash out refinance. Cash out refinances accounted for 59% of all refinance transactions in the second quarter. It's the most that they've seen. So that means that, I'll just call it 60%, let's just round, 60% of people that are refinancing are then taking out money. And think about the other point, the qualitative point to line up here is that if you're refinancing today, it's not because today is generally for most people a good time interest rate wise to refinance. There could be other reasons that you do it because interest rates are higher than what the vast majority of Americans have, like twice what the vast majority of Americans have. So people are refinancing, they're taking out cash, and 70% of those borrowers accepted higher interest rates. So that gets to that vast majority.
That's not so great.
No, it's not. And most of them are using it to pay off other debt. So they're taking out this new higher interest debt, but it's a lower interest rate than their credit cards, their auto loans, whatever it is that they're using to pay off. And so it's basically taking out a personal loan in order to pay off other debt, except you get a lower rate. That is happening today. And we have the highest amount of mortgage debt and the highest amount of non-mortgage debt than we've had in the history of the country. And so people's tappable equity has also gone up. So their ability to do this has gone up. If home prices don't continue to rise, which they've plateaued or dropped in a lot of places now, that's going to come to bite in the tuk-tuk at some point. But let me pause.
We don't make predictions on the show. At this point, rising home prices nationwide, at a nationwide aggregate, are very unlikely. There's 500,000 more sellers than buyers currently.
Yep.
Interest rates are still relatively high compared to the recent past. It seems much more likely that home prices go down or plateau than it does that they go up.
That's right. So this is not a positive. I can't say that it will lead to negative things. Again, we don't know. Predictions are worth the air that I'm saying it into. However, it's not a positive sign of where people are. It may turn out okay, but it's not a positive omen for where folks are. And we've discussed before how we could see potentially with what was happening with debt overall for people needing to sell their homes in order to get cash. And this could be step one in a two-step process of you're still using your home in order to get cash and not when it's opportune. When I've heard about the opportune times or more opportune times for folks doing this is like people that bought their houses in the early 80s. Interest rates were incredibly high. And since then, home prices elevated swiftly. So you had a period of time where equity was growing a lot and interest rates were coming down. Refinancing and taking out money during that time is different. During this time, we have to see. Who knows what's about to happen?
Yeah, but I feel like you're unintentionally only telling half the story here, and that's fine. Of course, they're doing cash out refinances. It's a unique economic time where there's uncertainty, inflation is up, and coming off the last 5 years, most home markets have gone up significantly. Their home is worth more than it was. and people are cash strapped.
Yeah,
What
that
do
makes
you do
sense
in that case?
Yeah, but the issue, however, if I look over the last 2 or 3 years, whenever folks were bringing up the fact that there was increasing debt, the opposing view would say, like, yeah, we get that there's increasing debt, but consumers are actually in a good spot. Like, look at their net worth is higher, cash is higher. And you go, oh, really? Then why are they doing this?
Oh, I see. You pulled a fast one on me here. So you're not actually arguing this, but what is owning a home when you don't actually own much equity in that? It's renting a home. When you buy the home, maybe make a few payments, and then as soon as the value of that home increases, you do a cash out refinance, that continues to be renting. There's an argument here. There's another argument that is people bought a more expensive home than they can actually afford.
All of this is true. None of it is positive. Because to your point about the refinancing, so you buy the home, you start making your payments, great. So now you've built up more equity. Even if the price of the home doesn't go up, you've bought at least into more equity. Then if you then take that equity that you've bought into and refinance it and cash out, you're just back to where you started. That's what you mean by you're just renting.
Yeah. Well, okay. You said none of it is positive, and I'm going to take issue with that because the listeners on the show will know this. I invest sometimes on a home rental platform where you can buy a portion of a home. And they've started a secondary market. It's been great for me because I can go in and do these really lowball offers on the Airbnbs that people bought that actually they don't rent and are going to have to sell soon. And I have some offers out there for like 30% of the purchase price of this thing. Man, if those things trigger, it's going to be great for me.
So this is great for Skippy, and it's great for some refinancing companies.
Yeah.
I'm talking about the American consumer.
I am the least bit surprised. I appreciate you bringing this up. It's a fascinating topic. I actually kind of liked the Instagram reel, but I'm not surprised.
Of course you're not surprised. We've been talking about something along these lines that things were probably going to lead to this for the past couple of years. I'm mostly raising this not to surprise you, but because it's important for folks to see and understand what is going on here. Okay, fishbowl. I'm reaching to the fishbowl. Let's go to Howard Marks.
Oh, Howard.
The sage. So Howard Marks, about a month ago, put out a memo. As y'all know, because we talk about his memos often, he comes out with memos on a quarterly-ish. There's not an actual calendar, but whenever he feels like writing it. This one, he says he was on an airplane and the Wi-Fi went out. So he's like, I'll write a memo. So he wrote this memo, Calculus of Value. And what it's about is how to value organizations, not in the technical term, but how to think about the value of companies and how to think about that relative to price. He goes through a number of different items through this memo, but that is the core part of it. I'm going to talk through mostly 2 parts of this, and then I'll drop one other factoid, which will not surprise you. Let me just come out and say that. Will not surprise you, but I think is good for people to remember when you think about where we are right now. Okay, so first, a few points on price and value. Value is what you get when you make an investment, and price is what you pay for it. A good investment is one in which the price is right for what the value turns out to be. Due to the volatile nature of investor psychology, asset prices fluctuate much more than fundamental value. Thus, most price changes reflect changes in investor psychology rather than changes in fundamental value. Last bullet under here. Because of the key role psychology plays in setting asset prices, in order to have a sense for where price stands relative to value, investors should try to gauge prevailing psychology, not just quantitative valuation parameters.
And that's like a Michael Mauboussin take at the end there. Expectations investing. You're trying to judge what other people think is going to be the future of the stock versus what is actually going to be the future of the stock.
And if anyone disagrees with these points, more power to you. I'm just going to name 2 companies, 2 stocks, Cracker Barrel and American Eagle. If you disagree with these points, go and look at the news and the stock charts of those 2 organizations for the past 6 weeks. Do you want to go back and break down any of these points? Anything stood out to you?
I want to elaborate on a couple things. So one, sometimes listening, there's a podcast for all the Howard Marks memos, or reading the memos feels like reading a textbook, and it can be taxing. It's always worth it, in my opinion. And I love the people that throw the shade that claim he's out there simply for marketing purposes and he knows nothing about investing. Like, by all means, guys, go buy your GameStops. I will collect the checks that he like. There's so much wisdom in there. There's literally free money to be had, which is why we talk about him so much on the show. Yeah. I like the breakdown of his current market conditions. So forward PE was around 23, implying a 10-year future return of between basically break even between positive 2% and negative 2%. He's just realistically saying what's probably happening with where we are today. Like, he's so good at saying it's a bubble, but I'm not explicitly calling it a bubble. Here's what the facts say.
Yeah, he's getting closer to that, though. He's getting closer to just calling it a spade in this one.
The facts are pretty weak. Yeah, I think you did a good job. I don't know. Is there anything else you want to talk about? Any specific points?
I want to hit more on the psychology point, because I do think that that's very important for folks. And the last thing that he says, which you said is also a Mauboussin, a strong Mauboussin point, is when you're looking at stocks and you're looking at what is the price to sales, what's the PE ratio, what's their dividend yield, let's look at the chart, what's debt levels. You're looking at all these different elements. It is also very important to look and think about what the prevailing psychology is at this moment. How are people thinking about the market? You say all the time, Skippy, that stocks trade at the price they're trading at for a reason, whether that's a really high price or a really low price. There's a story. There's a narrative. It doesn't mean that that's the right price at that point in time, but there is a story. There's a reason that's happening. And I think that that's critical to thinking about this and looking at, and there's not I'm going to say this as if there's some kind of calculator or math behind it. That's not my intention. But at any given period of time, there's some percent psychology and some percent fundamentals that's happening with every individual stock and with the market. And just having a general sense for where you think that is, I believe, is important. And it's a good reminder for me as an investor. One of the reasons I love Howard is not because when I read his memos, I go, oh, wow, that's a brand new novel thing that I've never seen or never thought about. It's because in the end, investing is like 5 fundamental principles or something like that. And it's good to just hammer them constantly, even after decades, to constantly hammer them back in for myself. I find it to be helpful.
Yeah, let me elaborate on the rest of the valuation metrics that are discussed. Price to sales, 3.3 times all-time high. Market cap to GDP, a record high. This is Buffett's favorite metric. And yield spreads near record lows, which means the risk tolerance is elevated. He's cleverly saying, gosh, things are expensive. And that's what's happened to me the past 4 weeks. Like, there's just, I don't want to say there's nothing to buy, but there's nothing that I can get excited about buying. And you watch these garbage stocks have massive bounce, like 5% a day, 10% a day for what? It's just based on a bunch of hyenas in the streets.
Yeah. One account that I help someone manage, I was looking at it yesterday and went, I think it might be time to get out of some of these holdings. And a lot of times when I'm getting out of something, I go, okay, what am I getting out of to buy? I went, crap, is it just bonds? That's like a place that I go, okay, well, I can't do that. Like, I need more time. I need more time for me I need like an oxygen tank for me to figure that out. But it's one of those things where I go, wow, okay. That doesn't mean there is nothing, by the way. I'm not saying that. It's just in my radar, my universe, what I'm looking at, et cetera. I was like, ooh, yeah, things are quite elevated.
For years and years, I looked at these like 80, 100-year back tests, and I'd often be baffled by the performance of cash because we lived in such a low interest rate environment for such a long time that I was like, why would you ever hold cash? I'm starting to understand it. Again, we don't give investing advice on the show, but it's a time where, gosh, making 4.5% on cash might not be the worst thing in the world for the right investor with the right psychology.
Yeah, that's exactly right. If you have a 4.5% return here and a negative 10% return here, you're making a 15% premium. That's it. That's it.
Doogles can do math. Look at that.
I'm real good with the additions and the subtractions. Okay. The second set of things is he follows up those other points, and this, similar to the last list that I read, they build upon each other. These are conditions for superior risk-adjusted returns. Keep that psychology point in your mind while I go through these. The consensus of investors doesn't fully comprehend the asset's current value. The market price is too low for the current value of the asset. The asset's value increases more than investors anticipated, usually because of an unforeseen increase in its earning power. And the asset becomes more popular with investors, resulting in an increase in its price that is unrelated to changes in value. Before you even hop in, this is when I'm going to put words in your mouth and you can spit them right back out if you don't like them. When you talk about mean reversion, he is laying out what that means. Like taking it from something that is this mythical, intangible thing of just, I'm going to hope and pray and wish that it comes back. What he's saying is, no, what mean reversion means is the consensus doesn't comprehend the asset's value. So then the market price is too low. So then the asset's value increases more than investors anticipated, and the asset becomes more popular with investors. If you think about that in reverse, which is when I look at that, I think about it in reverse now and go, okay, what are the assets that are not currently popular with investors? Because if you want something to then mean revert for the opposite to happen, you go, okay, what's not popular? Okay, well, let me think about it that way. And if it's not popular, do I think that it might increase more than anticipated because of something unforeseen? Okay, if that's true, let me look at the prices. Are the prices too low right now? And is that a result of the consensus of investors not fully comprehending the value? And that is, going to that in reverse is a really interesting screening tool.
Yes, 100% agree. You're talking mean reversion over here.
Okay.
I mean, the S&P 500 this year went down, I'm trying to find the exact numbers, down like 12% in the first 4 months of the year, and then up 22-ish% in the next 4 months of the year. I don't know the like, where's the actual fair value? It's probably between those two figures, but I'm not even convinced of that. It might be below the April lows.
Yeah, he says a part. Do you want to keep going?
No, it's just madness. It's like, this is a crazy investing year.
Yeah, and he says that in a different way in here, and I didn't pull the exact quote out, but he says this, I think in a couple different times, where he went, if you think about the pre-April Liberation Day situation that we were in, and you think about today, right now the market is higher than it was then, which you'd have to say that means that expectations are higher. People believe more in the future of the company assets and their value than they did then. He goes, okay, so let's take that. That's why a market would be higher. Then you look at all the fundamentals, start to ask yourself why. We believe that inflation will probably be higher than it was then. The view of America and its both rivals and enemies seems like it might be lower. So he was just like, so why would that be? And people can have reasons for that. I think that's great. Everyone has their own perspective. But asking that question is important. If the market's 10% higher, why? Here's the last thing I want to throw out. Won't surprise you either, but this is so important for people to think about. You know, there's been buy to dip. Oh, did I dip? Buy to dip. He says the last sustained market correction ended in early 2009, meaning it's been over 16 years since risk-bearing was seriously punished and buying the dips wasn't rewarded. That means no one under 35 or so, professional and amateur investors alike, has ever experienced a prolonged bear market.
Luckily, I'm well over 35.
Well, AARP, baby.
I know you saw, but Coinbase just moved their leverage from 20 times to 50 times. There are so many things happening in the market right now that show people haven't been around for more than 16 years and have never actually had to pay for mean reversion on the negative side.
That's right.
Significantly lower than where they think the fair value is, because that's what happens when people panic. That's what happens when their margin calls happen.
Yep.
Gosh, I don't want to root for carnage in the streets, but I kind of do. It is time.
That's
how I feel. It is time for the tide to go out. Absolute craziness.
When you sent me that Coinbase leverage change, the first number was, I didn't realize the first number was where it was. Yeah. So I've been to Chick-fil-A exactly once. And I went there because my brother-in-law loves Chick-fil-A. And it was before he got married. It was like a thing that he really wanted. So I drove up to Chick-fil-A. And I got one of those platters, whatever platters they have. And they go, what size sauce do you want? Like, what size dipping sauce? And I go, well, what's a small? I kid you not, this guy brought out a bathtub for the small. And I was like, well, then what's a large? Like, how do you even offer something that is larger than this? This is what I thought about when you sent me that. I went, that was the starting point?
It's like made up. No, I don't do the Coinbase leverage thing. So maybe there's more to it. It's an interesting time, Douglas. Just
that it is.
I'm happy I'm wearing my Uggs over here, and at least my toes are warm.
Okay, I think you got to reach into the fishbowl and talk about basketball contracts.
I love the fishbowl. This is not basketball contracts, Douglas. I know
it's
you're
not?
going to make it through this. Well, in a way. Let me get there. There are these dudes, major Democratic donors and supporters. Mm-hmm. But I'm not even going to go deep in the weeds. So a couple dudes create this company called Aspiration. Okay. And Aspiration was carbon offsets. So there was a time back in 2019, 2020, 2021 where this was hot, right? And basically all they were doing is agreeing to plant trees, and rich people that owned large organizations would say, I want carbon offsets for this, carbon offsets for that. People like Mark Cuban would be like, you know what, I travel a lot, but I love the environment, so I'll buy some carbon offsets. Yep. This company became a major sponsor for the Los Angeles Clippers, the basketball team.
All right.
They signed a $300 million deal to put their logos on the court.
There you go. That's a big deal.
And Steve Ballmer, what'd you say?
That's a big deal.
Yeah. The biggest by order of magnitude at the time it happened. Yep. Steve Ballmer became a supporter and investor in this company. He wrote a $50 million check. Steve Ballmer is the owner of the Los Angeles Clippers. For those who don't know, he's also the 6th richest person in the world, and by far the richest owner in the NBA. So he bought a franchise for $2 billion, that franchise, at the time that the going rate was like $500 million, because he was sitting on $150 billion and he wanted to own a basketball team. Like, money is paper money for him. I just have to establish all this.
Yep.
Okay. So what happens is Kawhi Leonard is arguably the best player in basketball at this point in time, and he's a free agent who's just won a title with the Toronto Raptors. Sorry for all the backstory here, but it's important. He ends up signing with the Los Angeles Clippers in a way that raises a lot of eyebrows. Now, he grew up in that part of Southern California, and there's some stuff going on.
Yep.
But what comes out this week via Pablo Torre Finds Out podcast is that he also managed to get $28 million deal to sponsor Aspiration, this carbon offset company, and $20 million of stock in the company.
Oh, wow.
Why does any of this matter? Well, one, it's pretty interesting that Steve Ballmer wrote them a $50 million check, and then Kawhi Leonard managed to get $48 million in contracts. There's a salary cap in the NBA, and circumvention of the salary cap has happened one time within the past 25 years. The punishment were the removal of 5 first-round draft picks.
Wow.
Suspension of ownership group, GM, et cetera. It's a very serious thing, because if there's not a level playing field, then it doesn't matter. And someone like Steve Ballmer, who is an order of magnitude richer than anyone else in the league,
they can run away with it,
can effectively build a super team outside of the salary cap structure. Any questions before I just put a bow on this?
No, bow it.
The only reason any of this is public is because Aspiration was a massive fraud. Founders are in jail and the SEC is investigating. So all their documents are public. Aspiration signed many other celebrities, folks like Robert Downey Jr., to do like commercials basically for them, advertising that they could do wholesale carbon offsets for you. All those other contracts are like orders of magnitude lower, like $1 million, right? So or less. Kawhi Leonard, his contract with Aspiration is now fully public. And the contract has these really weird clauses that says you have to do X, Y, Z unless that doesn't fit with your beliefs, and then you don't have to do anything. It's like the best no-show job ever.
Yeah. Wow.
Kawhi Leonard, one for those who don't know, he's a great basketball player, the least charismatic person on earth. Literally, the least charismatic person on earth. You don't want this. You don't want this guy selling any of your product.
Yeah.
In the in the time that he was under contract, he did not even so much as like a tweet. He did not show up at an event. He did not plant a tree. He did not do anything. I find this incredibly like it's fraud tied with professional sports, tied with salary cap circumvention. Yeah. I'm tried with 1,000 other things, but it really the overlap between investing, well, maybe not investing. The finance world is so fascinating because these guys at Aspiration went around and sold this as like the world's hottest startup.
Yeah.
And it was just a massive fraud. And I think what it all comes back to for me is there are so many people out there trying to take shortcuts to make a quick buck, to skirt the rules, to do everything else. And I think these folks cheated the system on all sides. Literally. They're scamming the NBA. Now Steve Ballmer is claiming claiming he doesn't know, which is tough to believe given the sequence of facts. But that he got scammed. All their investors are basically out. And the moral of the story is they didn't really plant any trees ever. I
picture the meeting where someone says, I got it. So what's profit? Revenue minus costs. What if we just didn't have any costs? Like if you just don't do the service that people are paying you revenue for, it's all profit. And someone else said, okay, it's hard for me to imagine how these things come about. Now, honestly, it probably comes about more gradually than that. Like even if you go to Elizabeth Holmes, like she intended at some point to build the machine. And then
it probably started with good intentions. Yeah.
But at some point, someone goes, what if we just don't do the thing? But we act like we do. People still seem to give us money when we don't do it. So they obviously don't care about seeing that we actually do it. It's scary.
Here's the deal. Salary cap circumvention in all professional sports is going to be taken very seriously. In this case, it seems crystal clear, given that they are the title sponsor of the Clippers, that Clippers ownership knew about it, and there will probably be severe punishments. But I think there's a way around this. I think if you have two people who are maybe part of the 10 richest people in the world. I don't know. Maybe they used to work for Microsoft. Let's call one Bill Gates and one Steve Ballmer. You could do something like this without a shady organization that's going to go bankrupt.
Yeah.
And you could just be like, call up your buddy, have no paper trail, shake hands with your buddy, sign the biggest free agent to a less than max contract, and then have him go get a sponsorship deal with, I don't know, a Nike-esque company for $300 million a year that comes directly out of your buddy's pocket, and you could exchange the Microsoft stock at the top of the house or something. It's kind of amazing that these allegations haven't come out before, because it has to be happening.
Has to be.
Because for Steve Ballmer, $50 million a year is literally like a penny falling out of his pocket. And
it's like
his joy in life does not come from money. His joy in life comes from his passions doing well. So that's the realization that hits me, is like Elon Musk. If Elon Musk really wanted to own a professional sports franchise, he should be finding a way to skirt the rules, to pay people $1 billion a year. Because what does it matter to him? It doesn't matter at all.
Fiduciary responsibility. You got to. This makes me think about the Find the Umbrella. I think it was Dilbert, where it was you submit your expense report. And it was raining. You were on a business trip and it was raining, so you bought an umbrella. You use the umbrella during the business trip, you expense the umbrella. And the people in the accounting team, they go, that's not an expense that you can make. So then he submits a different expense report that has meals and cabs, etc., and writes on the bottom, find the umbrella now. That is what it makes me think about.
You said find the umbrella like this is a commonly known business acronym or something.
Not something I saw sometime in one cartoon 19 years ago.
Yeah, but it should happen. By the way, NBA owners, if you need some help skirting the salary cap rules, you write Skippy and Doogles a $300 million check. We'll find some ways, all right?
Yeah. Go to skippylivesinthegray.com and you get all the info.
No, I just want people to know when Kawhi Leonard does the promo for our next episode, there might be something happening behind the scenes, guys. It's outrageous. It's
outrageous.
Truly, if you're interested in finance and sports like me, this Pablo Torre Finds Out episode is one of the highlights of the decade. Yeah. amazing reporting, super fun. No like clear smoking gun. Like you don't have Steve Ballmer's signature, but if you can put a few basic things together, the arrows point pretty clearly in one direction. Yeah, that's it. That's a wrap. Thanks for hanging out with us this week, and we'll catch you next week.
Thank you, everybody.